Good morning. Why Wall Street is targeting Houston real estate. And Houston is no longer a local market story. It's now a national and global capital destination. And institutional investors, private equity funds, real estate investment trusts, pension funds, and sovereign wealth capital are actively deploying capital into Houston commercial real estate or CRE right now. And the question is no longer if Houston is investable. The real question is why is Wall Street moving in now and what do they see that others don't? So, first is the population growth. That's the demand engine. And Houston continues to rank among the fastest growing metros areas in the US, driven by job creation across the energy, healthcare, and tech sectors, business friendly policies, and relative affordability versus coastal markets. Think more people equals more rooftops and more demand for retail centers, industrial and logistics space, but for multi housing and medical office. And the key takeaway is that Wall Street follows population growth because it creates predictable demand. Two is industrial and logistics dominance. And Houston is a logistics powerhouse, and it's anchored by the port expansion at Port Houston, energy exports, manufacturing growth, as well as e commerce distribution. And industrial assets in Houston are seeing rising rents, strong occupancy, and institutional grade tenants. And this asset class checks every box for institutional capital with stable cash flow, scalable portfolios, and long term tenant demand. Three, dislocation is an opportunity. And since mid of 2022, commercial real estate has repriced due to the recent rise in interest rates. And here's the key: Houston fundamentals stayed strong while pricing adjusted downwards. And what that does is that creates a pricing inefficiency, and Wall Street is built to exploit inefficiencies. So institutional investors are thinking right now that they can buy at today's basis and ride NOI growth over the next cycle, and then exit at compressed cap rates later down the road. Four is there's income driven returns and not just on speculation. Now, unlike equities or debt instruments, CRE returns are largely driven by rental income, occupancy, and lease structures. And historically, 80% of real estate returns come from cash flow itself and not from the appreciation of the buildings. So, for institutional capital, this means a predictable income stream with inflation hedging and tax efficiency. Five is the $1.5 trillion debt wall, and a massive wave of commercial loans is maturing over the next few years. And many owners are facing higher interest rates than when they originally took out their loans, but also lower valuations and tighter lending standards. So this could create forced decisions, whereas they could refinance with new equity or sell at adjusted pricing or bring in partners. And Wall Street sees this as distressed or motivated entry points for the market. Six is office challenges, and there's repositioning opportunities available. And Houston's office sector has elevated vacancy, but that's not a specific weakness. It is an opportunity for adaptive reuse. So think office to residential conversions, or medical conversions, or mixed use redevelopment. And institutional investors specialize in repositioning assets, injecting capital, and improving the NOI. Seven is suburban growth corridors are exploding. So areas like Katy or Fulshire or the Energy Corridor or the FM 1463 corridor are seeing massive residential growth, but also retail demand expansion and service-based business migration. And this aligns perfectly with the thesis that retail follows rooftops. So the final take for the day is, and why this matters for you is this next segment. And Wall Street doesn't chase headlines. It follows data, it follows timing, and it also follows real estate cycles. And right now, Houston checks all three of those boxes with strong fundamentals, a temporary pricing reset, and also long term growth tailwinds. So the strategic insight here is what smart investors are doing is they're buying stabilized industrial and retail, targeting value add with clear exit plans, and structuring deals for flexibility and not just the rate, but also partnering with capital sources early. And the opportunity isn't coming, it's already here. So if you want to position yourself like institutional capital, and if you're looking to, say, acquire commercial property or refinance before maturity risk hits, or structure deals that actually get approved, let's talk strategy. And that's it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get hold of me. Love to have a conversation with you. Reach on out.